Well, U.S. consumer sentiment tumbling further in May as the impacts of President Trump's tariff policies remain top of mind for Americans. And joining us now to discuss the latest data, we got José Torres, Interactive Brokers senior economist. Jose, always great to see you on set. Should we start there with the consumer sentiment this morning? I know it was weak, but I'm curious, as an economist, you saw that print, you saw that headline. What do you make of it?
You know, sentiment numbers and confidence numbers prior to COVID were a huge leading indicator as to what consumer spending was going to be like in the future. But since the pandemic, the inflationary surge, the most substantial since the 1980s, really affected consumer psyche. So we have this disconnect. Look at March. Adam, Josh, March retail sales through the roof. Sentiment confidence numbers in the basement. So we're seeing that significant bifurcation. As far as the outlook from here, you know, we have this trade agreement with the UK, a break on China. Investors and economists, my colleagues, very bullish in our prediction market. We're seeing a lot of yes buying on retail sales, GDP, Fed cuts, roughly 3 this year we're expecting based on our prediction market. So really bullish landscape, especially because now we're going to be tilting more to the most positive, traditionally GOP playbook kind of policy from the Trump administration: lighter taxation, milder regulations, low energy costs, and then slower moving onshoring progress in terms of manufacturing.
What's interesting to me about this, Jose, is not only has consumer confidence gone to multi-decade lows, investor confidence, multi-decade lows. So sentiment really is completely washed out. And I, ever the optimist, sort of look at that and say, well, is this as bad as it gets? And maybe, right, with the retail sales numbers hanging in there and the market turning already, is that a fair way to approach this?
You know, Adam, I think sometimes with the consumer sentiment numbers, a lot of the folks, the survey respondents, they don't necessarily have a lot of stock holdings. You know, so the concentration of equity holdings tends to be at the upper middle class, at the upper end. Those folks don't care as much when they go shopping to see prices up 10%, 20% on some items. And that's why we're seeing such a disconnect, a bifurcation in inflation expectations from the surveys versus market-based inflation expectations in the Treasury market. We're seeing huge numbers. 1 year is roughly 7% in UMISH, you know, in the Treasury market, it's in the twos. You know, so we're seeing these crazy bifurcations. And another topic, in terms of tariffs, we saw a big separation in yesterday's PPI. You know, core goods accelerated to the fastest rate in 27 months, but because services, food, and energy countered that increase in core goods cost, we saw the headline PPI actually drop to the steepest level since COVID. April of 2020, 60 months ago. So seeing a huge bifurcation. I don't think that the tariffs are going to produce much inflation. I think that we're going to be somewhere in between 2.5 and 3, and I don't think the Fed's going to have to hike against that backdrop.
Let me ask you, Jose, one argument I've heard from folks who come on here, put them in the more downbeat camp. A big argument was, I want to run this past you, was, well, CEOs are going to get frozen in place. I mean, all the tariff uncertainty, then, you know, it's going to impact investing decisions and spending decisions and headcount, and that's going to tip us into recession. Your response to that is what?
I don't think so, because the hiring has been quite buoyant, you know, and that's part of the reason why the Fed doesn't want to reduce rates, even though the CPI and the headline PC are at 2.3% right there. So, you know, they were reducing in 2024 and 2023 with inflation levels much higher than that, but now they don't want to reduce because they're not seeing that deceleration in the labor market.
Well, and that's a great point, right? The Fed has their dual mandate, or trying to do two things at once: full employment on one side and price stability on the other. It seems like what they're telling us is we're happy with the employment market, and God forbid prices go back up and then we got a problem, right? I mean, I think they're more worried about inflation returning than trying to help markets and investors and people buy homes.
You know, Adam, with inflation, there's so many different ways to interpret it. And that's why I think that it's more 70-30, more tilted to the labor market. Once you see payroll gains start to decelerate rapidly, like we saw last summer, June, July, August, and that's what motivated that double quarter point, that half a point cut in September, right? Once we start seeing labor market deceleration, Adam, Josh, the Fed is going to flip right away and start cutting.
Let's say Trump tax cuts, they get extended, Jose. How does that figure into your model and your expectations?
Well, I'm looking for a re-accelerating economic growth Our prediction market investors also feel that way. They've been dialing down recession odds, buying a lot of the no contracts, retail sales GDP buying the yes. Those tax cuts at the corporate level, at the individual level, that's going to free up some capital for more consumption, but more importantly for capital expenditures. And we saw in the first quarter GDP report, those CapEx numbers are really significant, the most since 2021, which was motivated by the recovery from COVID as well as the Inflation Reduction Act of the prior administration. So I think that that lighter taxation, a lot of folks are worried about the revenues, but we've seen this movie play out many times. You have those tax cuts and that investment comes in and it really grows the economy quite organically and structurally.
I like it. You sound bullish. So we were talking about inflation odds, and you just mentioned it. I was curious. I actually went back and charted. You can actually chart inflation odds over 50 years, and I found the average over the past 50 years is 29%. In other words, at any given moment in time, 29% of the people think, or I should say, economists like you think there's a 29% chance of recession. Where are you on recession?
Well, I was at 50-50 prior to a lot of the trade agreements. Now I'm down to roughly 25%. It looks like the Trump administration, they have a lot of folks that want to talk. They're even saying, listen, we don't have the staff. We don't have the head count. Maybe some of us here are going to have to go over there and help them negotiate. They don't have the head count to accommodate 150 countries that want a deal. So it's going to take some
And that's
weeks.
bullish and argues against recession because trade's going to work out.
Absolutely. Trade is going to work out. You're not going to have these kinds of separated supply chains and significant regionalization. We're still going to be working. It's still going to be a globalized kind of cross-border commerce landscape, but it's going to be the U.S. is going to demand a little more than what it did in the past. We're not going to be free traders and everyone else having levies, having rules, having currency manipulation tactics. We're looking to level the playing field a little bit. A lot of the areas in the country, particularly in the middle of the country, they'd love to see a little bit of a resurgence in manufacturing. Even if we don't recover the 6.8 million jobs that were short from the peak in 1979, even if we get 2 million of those back, that would be really good news for a lot of the communities around the country.
Sure would.
Jose, always great to see you, especially on set. Thank you, sir.
Thank you, Josh. Thank you, Adam. Great to see you.
Oh, thank you.